Almost certainly you've heard this debate. And if you're here, I'm going to venture a guess that you're contemplating this very decision yourself. On one side, you have the indexers, the group that believes that the market is an unbeatable machine. They tell you to buy the market and watch your money grow. To their credit, so far, history has suggested that this is actually a pretty good idea. On the other side, you have the stock pickers, the ones who believe that with enough research and conviction, they can outrun the pack. Let's be clear here. History has also told us that the vast majority of people who try to stock pick do, in fact, underperform the broader market. For the longest time, I felt like I had to choose a side. I felt like I had to sign a contract with one of these and stick to it for the rest of my life. But as I've gone through my investing journey, I have learned a great number of lessons, many of them through failure. I've tried picking stocks, and both failed and succeeded. And I've tried just indexing, and admittedly saw some pretty good results. As I've learned, I have come to the realization that I don't have to just pick one. I did something that a lot of purists hate. I decided to do both. I'm curious which side of this you guys fall on, so if you don't mind, let me know in the comments. But today, I want to walk through how I operate my personal portfolio. I want to show you exactly how I'm splitting my money, and why I use my work retirement accounts for the boring indexing, and why I use my Roth IRA for my wealth acceleration. I'm not here to tell you what to do with your money. I'm here to show you why I am intentionally divided, and how that division is giving me the best of both worlds through the lessons I've learned along the way. So let's start with the boring stuff, the foundation. Most of my net worth isn't sitting in Amazon, although admittedly right now I feel like I could make a pretty compelling argument as to why that might be a decent idea. I'm also not invested in a moonshot crypto play. In fact, I don't really get into crypto much at all. Most of my net worth is sitting in my work-sponsored retirement programs. Whether it's a 401k or some other tax-advantaged account, this is the core of my financial life. And in this part of my portfolio, I am 100% committed to being a boring indexer. Here's why I'm taking this approach. When I look at the historical data, the numbers for the broad market indices are staggering. Over the long haul, the S&P 500 has averaged returns that hover in the high single digits or low double digits. Now that might not sound like much when you see people on social media that claim to make 50% every week. They're likely lying, by the way. But when I apply the math of compounding over 20 or 30 years, these boring returns turn into a mountain of wealth. I'm ensuring one thing, that when the time comes that I'm ready to stop working, I'm going to be perfectly comfortable financially, by the lake, in my chair, with the beverage of my choice. I use index funds in my work accounts because I want to capture the average. In the world of investing, average is actually elite. I've read the reports showing that over a 15-year period, more than 90% of professional fund managers fail to beat the S&P 500. If the guys in high-rise offices with Ivy League degrees can't beat the market, I have to be honest with myself about my own core money. I don't want to gamble with my lake retirement money. I find it pretty arrogant to act as if I'm smarter than the analyst on Wall Street. By indexing in my work accounts, I am guaranteed to get my fair share of corporate growth. I own the tech giants, the healthcare innovators, and the retail staples, all at once. If one company fails, it's just a tiny drop in the bucket. This gives me the psychological peace of mind that I can't put a price on. I can put those accounts on autopilot, set my recurring contributions, and I don't have to check the ticker every 5 minutes. It allows me to live my life while my money does all the work in the background. Now, I just gave a very compelling argument as to why you should just simply index. There are an infinite number of combinations of funds that you can buy to lean one way or the other to try to gain an edge even while indexing. You can tilt towards sectors, large cap, mid cap, small cap. You can go international. There are no shortages of index funds or ETFs to choose from. Pick the ones you want, make sure you look at the expense ratio, and move on. But I admittedly do enjoy trying to beat the market. Through all of my successes and failures, I have learned so much. In 2025, I got really serious about it, and I made that my year to beat the market. I succeeded. Not only did I succeed, I crushed the market in 2025, returning approximately 30% versus the S&P 500, which returned just under 18%. This leads me to the second part of my strategy, stock picking in my Roth IRA. If my work retirement account is the core, my Roth IRA is the satellite. This is where I'm actively looking to gain alpha. that extra return that sits above and beyond what the broad market provides. But I'm very intentional about where I do this. I don't like to pick stocks in a taxable brokerage account, where every win is met with a tax bill. I like to do it in my Roth IRA. The reason is simple: tax-free growth. If I identify a company that I believe is undervalued and that stock triples in the next 5 years, I get every penny of those gains tax-free when I retire. That is a massive mathematical advantage that I simply can't ignore. See, if you follow my channel, you know that I do a lot of valuation guides on various stocks. If I talk about quality companies, I'm talking about individual stocks that I'm looking for that have a few specific things. I'm looking for the wide moats, companies that have a competitive advantage that is nearly impossible to replicate. I'm looking for strong management, and I'm looking for companies that I actually understand and use. I often cite that I'm looking for companies that are profitable, growing, and safe. The narrative has to tell the story of success, not just recently, but one that suggests strong potential in the future as well. I find that stock picking keeps me engaged with the world. It forces me to learn about economics, consumer behavior, technological shifts. It turns investing from a passive chore into an active intellectual pursuit. When I buy a stock, I'm not just buying a ticker symbol. I'm buying a piece of a business that I believe in. Now, I would be lying to you if I said that stock picking was all sunshine and rainbows. It's incredibly difficult and emotionally draining. When you index, a 2% drop in the market is a bad day. When you pick stocks, a 20% drop in a single holding is a very real possibility. I've had moments where a company that I felt high conviction in released a bad earnings report and the stock plummeted. In those moments, I have to deal with the ego hit. I have to ask myself, was I wrong? Or is the market just irrational? That kind of stress isn't for everyone. It requires a level of discipline that would keep most people awake at night. This is exactly why I don't do it with my entire portfolio. If my stock picks go to zero, a very unlikely but technical possibility, my retirement foundation in my work accounts is still rock solid. My alpha strategy is a value add, not a necessity. Another major con of stock picking is the time commitment. To do this right, it takes time and understanding. I have to analyze every earnings call, an annual report, keep up with the latest news, and watch the macroeconomic environment for shifts to the current narrative. If you don't enjoy that process, stock picking will feel like a second job, and it pays you in stress. For me, it's a hobby I happen to be passionate about, but I always have to remind myself that my time has value too. I admittedly use AI to help me sort through a lot of the noise in the stock market. I want to stress that while this can make things easier, you have to check behind your AI. They do occasionally read old reports, which will give inaccurate analysis. I typically do a spot check for numbers whenever I let AI analyze a stock for me. And I normally am pretty familiar with the stock I'm asking, so I can spot these anomalies pretty easily. The reason I've landed on this hybrid approach is that it solves the psychological hurdles of investing. When the market is booming, my index funds do great, and I feel like a genius. But when the market is flat, and a few of my carefully selected stocks are soaring, I feel a sense of accomplishment that indexing can't provide. Conversely, when my individual stocks are struggling, I can look at the 401k and I can see that the broad market is holding the line, which prevents me from making the panic-driven decisions. I call this a sleep well at night strategy. I get the security of the index and the upside potential from the individual picks. Right now, I currently have 3 concentrated positions, all within my Roth IRA and individual stocks. All 3 positions make up roughly 55% of my total Roth IRA value, with the remaining 45% being in indexes. This is a risk, but these are the companies that I have the most confidence in over the next 5 years. As I look forward to the next decade, I am going to stick to this plan, and I'm not going to be tempted by the YOLO traders that tell me I'm being too conservative. I'm setting my own targets. I'm looking for that sweet spot where I can benefit from the collective genius of the entire global economy through my indices, while still taking calculated shots on individual companies that I believe will define the future. My goal isn't just to have the most money, it's to have the most conviction in how that money is being managed. By separating my safety money from my growth money, I've created a system that works for my personality. I'm under no delusion that I will have the same success that I had in 2025 and crush the market this year too. I might also lag the market, but my conviction in these companies is solid, and I believe that in the long run, I will create the alpha that I'm looking for in excess of the base market returns. So, at the end of the day, indexing versus stock picking, it's a false choice. You don't have to pick one side of this war. You can be a diplomat who decides to choose each one. I index because I recognize that the market is smarter than me over the long term. I pick stocks because I believe that in specific tax advantage buckets, I can find opportunities that the broad market hasn't fully priced correctly yet. This is what I'm doing with my money. It's a strategy built on a foundation of humility, the index, and a little bit of confidence, the stock picking. It's not about being right all the time. It's about being protected most of the time and prosperous when the right opportunities arise. As always, best of luck in your investing, and thanks for your time. We'll catch you in the next one.